Mark, I know you're big picture, but are you going to be watching these regional bank earnings maybe closer than usual over, the next, once we get into them Friday and then the week or so beyond? Because the bank situation seemed to factor so much into the Fed's thinking most recently. You have to imagine it's going to continue to factor in, and how much they say about loss reserves, kind of what they say about the future, seems important to the broader economy.
Yeah, you underestimate me, John. I'm not that big picture. I will get down to the 5,000-foot level and take a look around, maybe even to the ground level at some points in time. But yeah, I think these bank earnings matter a lot, and particularly what the banks tell us about what's going on with their earnings, and going back to their underwriting standards and what it means for the availability of credit, and most importantly, what's going on with regard to their outstanding loans, their net interest margins, and ultimately what's going on with deposits. So yeah, I think we need to listen to this what they have to say very, very carefully, because that's really critical to understanding what the impact of the banking crisis will be on credit flows and ultimately on the economy, and ultimately what it means for interest rates and monetary policy.
Yeah, the clock is also ticking on the debt ceiling and the standoff we're seeing there. You saw Speaker of the House McCarthy make comments about the fact that this is actually becoming worrisome last week, the end of last week. Is this, in fact, becoming worrisome? Is this a growing risk right now that investors should be paying closer attention to, or do we still have time here?
We got a bit of time, Morgan. And by our calculation, the Treasury is going to run out of cash to pay everyone on time. That the so-called X date in mid-August. Right now we're estimating August 18th is that drop dead date. So my sense is what will happen is we'll come back from July 4th, the July 4th holidays, and we'll start focusing on this. And I think it doesn't look like lawmakers, Congress, and administration are getting it together reasonably so, I think angst in the markets will start to rise, pretty considerably, particularly as we make our way into August. So, and obviously the timing is bad, right? I mean, I do expect the economy to weaken here, unemployment start to rise. And once unemployment is rising, that's when the economy is most vulnerable to anything else that could go wrong. And of course, a breach of the debt limit, or even threatening to breach the debt limit, is something that I would qualify as something that could go wrong.
All right. Add that brick to the wall of worry. Mark Zandi, thank you.
Thank
Still
you.
ahead. Does Apple have a demand problem? New data from IDC says Mac shipments fell sharply, very sharply, in the first quarter. We're going to look at what that means for Apple's upcoming earnings and the entire hardware industry next.
And do not forget, you can catch us on the go by following the Closing Bell Overtime podcast on your favorite podcast app. Morgan and I will be right back. Welcome back to Overtime. Apple was down about 1.5% today, and part of the reason might be questions about demand. IDC reporting that Mac shipments were down 40.5% in Q1 for the biggest drop among the major PC makers. So is that a big deal? Well, not yet. So here's the story. Shipments aren't the same as sales. Shipments get product into the store shelves. And Q1 shipments might have been down because retailers still had some inventory left from the holidays. When you'll recall, there was spotty demand in December. And the first half of the year, seasonally weaker for PCs anyway. Plus, Apple CEO Tim Cook, aggressive when it comes to managing inventory. So here's another wrinkle. TSMC, Taiwan Semiconductor, today reported a sharp drop in March revenue, down 15%. And that might be a sign the industry doesn't want to overbuild in a very uncertain macro environment. But you can't conflate that with Apple's shipment drop. Apple actually might be clearing the channel ahead of new product launches in the back half of the year, Morgan. And, Apple's got WWDC coming up in June as well. We tend to get some announcements there. They're just about done with the transition to their homegrown chips. There are a lot of things that this could mean besides just demand problems in the channel.
You just moved from our stage back here, our wall back here, so fast. I'm lickety split. I'm very inspired right now.
I love moving around. It's been too long since I've been on set, so good to be back.
Yeah, it's good to have you back here. It is interesting to see Micron popping 8% today. You saw Western Digital, similar gains today on these headlines, and this idea that maybe you're going to see a tapering in memory supply and what that means for future inventories. The entire ecosystem seems like it's going through a correction right now, and this inventory destocking and sort of this return to whatever normal is going to look like post-pandemic.
Big questions about what demand and the overall economy is going to look like in the back half of the year, though. A lot of people are saying, back half is going to look better, working through this inventory now. But if there's a recession in the back half of the year, how's that going to affect demand? Mark Zandi, we're just talking about that. Now we can start asking him questions about specific companies, because he says he gets down to 5,000. You can see a lot at 5,000 feet.
Yeah, and you can argue that Apple's a barometer for the broader market, too. We have that conversation a lot.
All right, we got breaking news on some fresh comments from New York Fed President John Williams. Steve Leisman has those details. Steve.
Hey, John, thanks very much. New York Fed President John Williams saying that Fed rate hikes were not a driver of the trouble at the banks. It was sparked by some of the stresses that were out there. He says the trouble with these failed banks were unique to these banks. He says we haven't seen any clear signs yet of credit conditions tightening, even though, of course, his survey of consumer expectations today did show some of those concerns on the part of regular households. He is watching for the possibility, and he also stressed, by the way, that he sees the difference between monetary policy and regulatory tools. So that's kind of a way of Fed officials saying that they think they can hike and deal with the banking issues such as they are without changing what they think is the proper monetary policy. He says he expects to see unemployment rate rise gradually to 4 to 4.5%. It's now around 3.5. It went down on Friday. He says the stability of unemployment has been a striking development. He also sees inflation this year still well above the Fed's 2% target at 3.75. Expects to get down to 2% only by 2025. Though he does see rent-related price pressures coming down sharply, he said. And then one other aspect which is good for long-term thinking. John Williams is a well-known expert on the issue of what the long-term rate of interest is, and he says the natural rate of interest is likely still low despite things like deglobalization. Morgan?
2025, I just want to go back to that for a second. If you don't see inflation come down to something closer to 2%, is there any chance, is there any possibility that the Fed would cut before that?
So the Fed has used this phrase, Morgan, which they talk about being confident that it's on the way to the 2% target. Nobody is quite sure what that looks like. Nobody is quite sure what the Fed is exactly looking for. But you can imagine if inflation was falling sharply, first you'd have a pivot and the Fed would pause, and then you would maybe have some cuts if the economy looked like it was worsening, if indeed it looked like inflation was headed to 2% every month after month. But, Morgan, the problem is we can't even put a couple good months of inflation numbers together.
what's going to make this week's inflation data, CPI and then PPI, that much more important to watch. Steve Leisman, thank you.